What is up, my beautiful people? Welcome back to episode 4 of the Zero to Market Engineer series. In the last episode, I covered all the different concepts that you are going to need to be profitable as a day trader. I didn't go into depth on each of these concepts, but I mentioned the ones that you should study. And just watching that video alone is going to be enough for you to actually go out and do research on the things that you need to understand. Now, don't fall into a rabbit hole because it's simpler than you think. In this episode, I'm going to be focusing on timeframes. Timeframes are one of the most important things to understand, and without the knowledge of fair value gaps, you won't understand the way that timeframes work and which ones are significant in the current scenario of the market. So I'm referencing current price action. This video is a few days after the last one that I uploaded, so it's going to be a different market than the one I was showing you guys previously, but how do you understand timeframes? What are the key components to understanding which timeframe you're going to be using in that current moment? So first things first about timeframes, there's some generic rules that I like to follow. And that starts with, it's a little too small. That starts with higher timeframes, more significant. And the math, the reason behind this is because, think about it, each one of these candles represents whatever time frame you're on. So if you're on the 4-hour time frame, as I am right now, then each one of these candles will take 4 hours to print. And why this is significant is because this tells you essentially where the market's going to go in the next 4 hours. So if you're looking at confluences that we are supposed to learn, as I mentioned, fair value gaps, then on the 4-hour time frame, you're using a 4-hour fair value gap to determine where the 4-hour time frame is going to go. So in this case right here, we have a bearish fair value gap, which became an IFPG. It closed above and tapped back into it. The wick even respected this fair value gap by pulling all the way back up before closing right around the midpoint. So this is a sign of it respecting it. And we know now in the next 4 hours, it's likely going to expand now. And we have 4 hours of a bias. We have 4 hours of a narrative that's going to go up. It's only enough on the 4-hour time frame to determine where it's going to go on the 4-hour, in the next 4 hours. If you want to hold longer than that, you're going to need to scale out and think about where it's going to go on the daily time frame, where it's going in the context of the weekly time frame and then the monthly time frame. And essentially how you think about it is if typically the seasonal tendency of a month is bearish, then what you're doing is you're scaling down to the weekly and daily, and you're trying to find high probability sell areas to where you can get in, say above highs. You can get in for a sell above highs to catch the expansion towards a bearish month. Same thing on the weekly time frame. So the higher the time frame, the more significant, because it's telling you that in terms of the daily 1-day time frame is going to tell you where the daily candle is going, right? And the weekly time frame is going to be pointing you towards the direction of the week, and it takes a week for that to play out. And inside of that week, there can be plenty of bearish daily candles. Same thing on the 4-hour. Even if the 4-hour is bullish, there can be plenty of bearish moves like this. That's manipulation. But how do you determine what time frame to use? And this comes down to this concept right here that I marked out. It's going to be fair value gaps. So in the scenario where there is no fair value gap on the 4-hour time frame right here, that's when we scale down and try to find one on the 1-hour time frame. So on the 1-hour time frame, right, that was a singular 4-hour fair value gap. On the 1-hour time frame, you can see that all of these previous candles rebalance the wick, so there's no fair value gap. See how each wick right here is overlapping? That prevented new fair value gaps from forming. And the only fair value gaps that we have right here is this one up here and this one down here. And what you can do some of the time is pinpoint exactly a smaller area that you can actually use for an entry by using the lower time frame after you find a higher time frame one. So in a scenario like this, we might have had this IFG right here as our pinpoint entry, but it seems like in this case we might have tapped into something on an even lower time frame. Let's scale down to the 30-minute. Okay, I think it was this one right here. So you can pinpoint using the lower time frame and for value gaps what confluence it respected. And you can see that's crazy. There's a IFVG right here on the 30-minute time frame. And while we had a 4-hour bearish fair value gap, so we knew that we were going to go down in the context of the 4-hour time frame, we could have used the 30-minute time frame or the 1-hour time frame to say, hey, even though I know we're going to go down in the higher span of things, in the span of 8 hours, we're going to go down. Even though we're going to go down, I see that we just closed above a bearish fair value gap, created a bullish one right here. You can see we closed above it and we started respecting it. And you can see there are no fair value gaps anywhere here. And the only next fair value gap in this leg right here is the one to the left right here. This is the only one. There's nothing lower. You can see there's no fair value gaps lower, and there's only one above. But this one right here is the only one right here. And you can see that the market used a 30-minute bearish fair value gap as a bullish confluence once it closed above to go to this one before actually melting in the 4-hour context. So on the 30-minute context, you could have caught a buy into a super precise sell, and you would have used the 4-hour time frame as your narrative that it's going to go down in the span of 4, 8 hours, however long it takes. And that's essentially how you use time frames. And there's going to be plenty of different scenarios, and the best way for you to actually figure out how to manage these time frames and which fair value gaps to use. Typically, there aren't many fair value gaps. Right here, for example, on the 30-minute time frame, there's this fair value gap right here. Let me delete everything else so you guys can see on the higher time frame. So I'm going to scale out right now after marking this out, and you're going to see that it doesn't even exist on any other time frame. So you can see this right here is a bullish fair value gap. When we close below bullish fair value gaps, they become bearish confluences where we're looking for sells from them, right? Now, if I scale down scale up to a 1-hour time frame, you're going to see that this fair value gap right here doesn't even exist. So let's go back and try to find that. So on the 1-hour time frame, you can see that there is nothing right there. There is nothing. So if there's nothing on the 1-hour time frame, then what you're looking for is you're looking to scale down to a lower time frame that actually contains a fair value gap. And you can see that in this case, we did contain a 30-minute fair value gap. On the 1-hour, we could have used this as our entry. Now, if we were looking to add, we have a 1-hour bullish fair value gap that got closed below and used as a bearish confluence. So now we tapped into it, started running lower. If you're looking, or you might have missed this move, you might have been asleep during this time. So now you're looking for a trade when you're up, when you're actually able to trade. And you see, okay, there's nothing on the 1-hour time frame anymore. So I'm going to scale down and try to add a position because I'm still confident that we're likely going to run down and take out this low, for example. That could have been your target, right? So you scale down to the next possible time frame with a fair value gap. And we did have a fair value gap on the 30-minute time frame, as I was showing you guys. Bullish fair value gap closed below. So we ran from a 1-hour. We used a 30-minute to continue the move. We respected it once, twice, and a third time, and even a fourth time right there. And then we ran down and actually took out that low. So essentially, this applies to every time frame. If there's nothing on the 30-minute time frame, usually my psychology behind it is if there's nothing on the 30-minute time frame, there's not enough volatility in the market to actually trade a high probability move. If there's no 30-minute fair value gaps, I'm not looking to scale down to the 15-minute time frame or the 5-minute time frame because it's likely just consolidating and the market's actually just not going to go anywhere. And if it does go anywhere, you're going to have a very difficult time actually catching the proper move because you're going to face a lot of doubts when it's supposed to run up, right? You have a bullish confluence or bullish narrative, but all of a sudden you get a random bearish move, another bearish move. And all these little bearish moves are just unnecessary chop that's going to take you out of your positions. The kind of moves that we like watching are these rapid expansions down. These are the ones that we want to aim to catch. Like this one right here. We tap in, we get into our position, and right away, the market is over 100 pips away from our trade. That's the kind of trades that we want to be in. We get into this trade, right? We hold it a little bit because we get chopped up for 2-3 candles here. But then as soon as we get into that position and we start expanding, all of a sudden, all these candles are below this 30-minute fair value gap. And we got into a position where we can essentially hold our position and it's always going to be below this level. We're always going to be in profit as long as we entered above this level inside of the fair value gap. And then we catch that big expansion down, we sweep that low, and we just rapidly expand. Those are the kind of trades that we want to be in. And if there's nothing on this 30-minute time frame, I'm not looking to scale down. If there is something on the 30-minute time frame, then you can make it even more precise by scaling down to the 15-minute, 10-minute, 5-minute, whatever. You scale down, you find that extra confirmation or anything else that you're looking for to add more positions, to keep going, to catch a move from this leg right here. So you look inside of the bullish candle before it and try to catch some IFVGs inside of this leg. So that's how you use time frames. It's your job to actually figure it out. I'm just kind of conveying to you how I use it and my psychology behind it. If there's nothing on the 30-minute time frame, there's not enough volatility, there's not enough movement in the market, and I'd rather not trade than to get chopped out. And if there is a 30-minute fair value gap and a 1 hour fair value gap, you're going to ignore the 30-minute, you're going to go to the 1 hour, and you're going to wait a little bit longer because obviously the 30-minute is going to take 30 minutes. The 1 hour time frame is going to take 1 hour to actually close and show you where it's going. So if there is one on the 1 hour, you're not using the 30-minute, okay? It's not going to respect the 30-minute over the 1 hour. It's always going to respect the 1 hour. It's going to take a little bit longer to play out, and you should have patience. If there's a 4 hour one in that same exact zone, you're not going to use the 30-minute. You're not going to use the 1 hour. You're going to wait and use the 4 hour time frame. You're going to wait 4 hours if you have to, or 8 hours, or 12. Like in this situation right here, we're literally just consolidating. We're staying inside of this range, and even though there's that bullish like fair value gap, we're not running up because on the daily time frame, we're likely going to expand higher. I did a weekly analysis on this. I said that it's a little too good to be true, and there's still a bearish monthly narrative that we need to target. And on the 4 hour time frame, you can see that it's like taking a while, and it's respecting this level right here. So it's respecting this bearish IFVG on the 4 hour time frame. And so this move's going to take a while, and I'm going to be there to wait for it. I'm going to wait for however long it takes for this move to actually happen. And then there's another fair value gap right here. And once it actually runs up into it, and if it has like 3 hours left and it's right here right now, it's likely going to take 3 hours before it actually pulls down and tries to close right here. So I have to wait 3 hours, and my trade will only happen in the next 4 hour candle. Even if that means it pulls back down and opens right here, I'm going to catch a trade somewhere around here. And the expansion is still going to be nice because my narrative is going to be correct. My bearish narrative is correct. And that's essentially how I trade using the different time frames. And time frames with fair value gaps are how you actually understand it. That's how you understand which time frame you're going to be using in that day. There's no such thing as the perfect time frame. The best time frame is the one with a fair value gap in that current context. And that's when you scale down after finding the narrative, like 4 hour narratives bearish right here. We're respecting this IFVG in the next daily candle. Because this is a bullish confluence, I'm obviously going to be expecting some buy side, at least some buy side from this bullish fair value gap that we have on the daily time frame. This one right here. So when the next daily candle opens, I found that there's this 4 hour fair value gap right here. So what's likely to happen is that when the next daily candle opens, it's going to make everyone think that we're going to run up and keep going higher. But it's actually just tapping into this one, pretending like it's going to be a bullish daily range. And then it will actually expand lower, create the IFVG, and then continue lower. That's my narrative, my personal narrative. And that's not financial advice. You have to go analyze and make your own decisions. That's just what I'm going to be looking for if that does happen. I feel like it's just really obvious that we have built up highs here, and right above those highs, we have a fair value gap. So that's what I'm looking for. I hope you guys learned about time frames from this video, and I'll catch you guys in the next one. Peace out.